Alrighty, welcome to another monthly recap. This is for the month ending today, March 2025. I hope you all had a wonderful month. So, what are we going to talk about? There's a lot to get into. So, one, we're going to be talking about market volatility. It has been an extremely volatile month with regards to mortgage rates, the stock market. It's just been a lot of volatility in the market as a whole. So, we're going to be talking about that. There was a big Fed meeting this month. While the Fed didn't change the Fed funds rate, there was a lot of insight that they kind of gave us, and it's kind of interesting to see where the Fed thinks things are going. It was a really, really important meeting. We're going to be spending most of our time talking about that. It was a good month for inflation. Talk about that briefly as well. And that's good news because the inflation figures, they really don't have a lot of time to make real strong headway before things are going to get very tough. Talk about that as well. Mortgage rates actually ended the month very similar to where they ended the month last month, right around 6.625% for a 30-year fix, first-time home buyer making less than 120% of the area median income, kind of one of those ideal scenarios. Now, between over the course of March, there was a lot of volatility with regards to rates, but they actually ended the month very similar, if not identical, to where they were quite literally a month ago. Holidays, not a whole lot for March. Happy St. Patty's Day. I know I'm late. All right. Let's talk about market volatility. So the markets had an extremely turbulent month. If you recall, the new administration said, hey, look, on day one of the administration, we are going to roll out tariffs on Canada, on Mexico, on China. And they didn't do that. There was a slew of executive orders, executive actions, and those tariffs were not part of that. So the markets took a deep breath and they took a sigh of relief. And they're like, great, we don't have to worry about increasing in costs. We don't have to worry about this trade war going on. Everything's hunky-dory. Fast forward just a couple weeks, and then all of a sudden tariffs started to be implemented. And then they started to move out those goalposts and say, hey, we're not going to implement these tariffs for another month or two while we hammer out some of the negotiation, use this as leverage and kind of negotiate the terms we want. And then they kind of reverse course again, and they put forth tariffs. So the markets are like, what the heck is going on? We don't know what direction. We don't know what's happening. We don't know when anything is happening. It's just been very turbulent, very volatile for the markets as a whole. I'll show you a slide on the next slide that shows exactly that. There's concerns over tariffs. Tariffs are inflationary in nature. We don't like inflation. We've already had a number of years with elevated inflation. The last thing the markets want is additional inflation. Tariffs are indeed inflationary in nature. Consumer confidence has been kind of waning. Probably tied to tariffs in some ways, right? If you don't have a lot of confidence in what you think is going to be true, how are you going to have a lot of confidence, right? Makes a lot of sense. So, and then talks of a recession. I mean, Trump was actually asked, hey, look, are you going to rule out a recession? And he's like, no, I'm not going to. They've also talked about, hey, look, with a lot of this kind of negotiating in better terms, it's going to cause some pain. It's going to cause some pain. The markets did not like that talk either. And then the Fed took note of all of this, and they weighed in as well. So let's talk about that market volatility real fast. So this is the S&P 500, okay? So if you every single one of these candles, if it's a red candle, that means the stock market's going down. If it's a green candle, it means it's going up. Well, look at the volatility here, right? From the end of February through today, just huge swings. The longer the candle is what these are called, the more volatility out in the markets. So this, for instance, would be very little volatility. The market basically closed where it started. Yeah, this is a very, very volatile market. Your 401k has certainly seen that impacted, right? Volatility is bad news for the stock market, good news typically for mortgage rates. And honestly, it's a big reason why, even with this tariff talk, which is inflationary in nature, and mortgage-backed securities, which mortgage rates are based on, hate inflation, the volatility in the stock market actually helped them kind of recoup some of those gains. So tariffs are bad, but the volatility is actually good for mortgage-backed securities. Mortgage-backed securities are considered a safe haven, a safer investment, right? It's got a fixed rate of return. It's very stable typically. So stocks and bonds tend to move in opposite directions. When stocks are having a good day, bonds tend to have a bad day. The tariff talk would normally cause mortgage rates to jump, but with all the volatility in the stock market, most of that impact was actually mitigated. So stocks had a really, really bad month, no way around it. But bonds actually had a decent month. They recouped most of their losses from earlier in the month. So not bad news for mortgage rates necessarily, but bad news for your 401k. I'm sorry. All right, so let's talk about the Fed, okay? So the Fed wrapped up their March 19th meeting. It was a meeting associated with a summary of economic projections, okay? What that means is these are the biggest meetings of the year. summary of economic projections. And they only do it a few times. So March 19th, June 18th, September 17th, and December 10th are the 4 meetings where they're going to have the summary of economic projections. That's when the Fed comes out. They don't just say whether or not they decide to cut rates or hike rates or whatever. They also have to show their work. They have to show where they think GDP is going, where they think the unemployment rate is going, where they think inflation is going, where they think the Fed funds rate is going. So they weighed in on all of that. So while, they didn't actually cut rates, I would argue that they probably had, decent enough data to kind of cut rates if they wanted to. They decided to kick the can and not cut rates. Fine. The current expectation is that they will likely cut rates at that June 18th meeting. That's the current odds-on prediction. But let's get into what the Fed discussed at their March 19th meeting. It was an important one, like I said. So as you recall, the Fed has a dual mandate, okay? Their job is to keep prices under control, i.e. manage inflation, and then 2, maximize employment. That is their dual mandate. Those are the 2 things that they are concerned about. As I mentioned, they did not change their Fed funds rate. They left rates exactly where they were. A lot of people were not very happy with that, but that's what they did. Like I said, they also have, the odds are currently predicting a June 18th cut when they meet next time. Is it possible that they cut rates at the May 7th meeting? Sure. However, they prefer to cut rates on these big meetings when they have a chance to not just, like I said, cut rates, but also show their work and explain why they did what they did. Okay, so that's going to be very interesting to see. Maybe they do cut rates in May. More likely, it's going to be that June 18th meeting when they look to cut rates. All right, so what did the Fed think is going to happen with regards to GDP? Really, really, really interesting stuff. Maybe only if you're a money nerd like I am, but I am a money nerd, so bear with me. So this is 2025. This is 2026. This light blue line that you can see here is where they thought things were going to be when they met last time in December and they had the summary of economic projections. Okay, and then this dark blue or the actual blue boxes here are where they most recently at that March meeting think things are going. So it's really interesting. If you look at the December projections, they thought the GDP was going to be much stronger in 2025 and 2026 compared to their most recent meeting just a couple of weeks ago. Okay, they thought, hey, look, GDP is going to be 2 to 2.3% by the end of the year. Yeah, they are no longer predicting that. Okay, they've reduced that to 1.8 to 1.9, 1.6 to 1.7. Some are predicting as low as 1 to 1.1%. 2026, very similar story. They had really high expectations for GDP when they had this summary of economic projections back in December, and now they've been cutting it. Okay, Atlanta Fed, really interesting stuff here as well. So they thought that the Q1 GDP for 2025 was going to show 2.3% growth back on February 14th. Not that long ago, right? Well, fast forward to March 4th, literally just a few weeks later, they cut that from 2.3% growth to 2.8% contraction, negative 2.8%. That is crazy. They went from 2.3% growth to negative 2.8%. The Atlanta Fed feels really, really crummy about where the economy is going. And the rest of the Fed kind of follow suit. They didn't go quite that drastic, but they certainly, took a chainsaw to their expectations for where GDP is. I talked about consumer confidence weighting. Yeah, that is evident here. Okay, so very interesting stuff on the GDP. The Fed is starting to feel less optimistic, less rosy about the overall economy and our gross domestic product. Let's talk about the unemployment rate. Kind of a similar story, right? When they met back in December, they thought, oh yeah, the unemployment rate is going to be pretty low, 4.2 to 4.3% by the end of the year. In 2026, they were saying, we think it's going to be closer to 3.8, 4%, somewhere in that area. Yeah, not so much lately. When they met just a couple weeks ago, they increased what they think that unemployment rate is going to be. It is now widely expected that unemployment rate is going to hit 4.4 to 4.5% by the end of the year. Again, the Fed is feeling less optimistic, less rosy about where the economy is. Very interesting stuff here. They changed their minds very quickly. December to March, that is not a long window. And they, again, just take a chainsaw to their expectations. They think unemployment is going to get hotter, worse than they did just a few months ago. What about inflation? They are also feeling less optimistic about inflation. Okay, when they met in December, the vast majority opinion was for 2.5 to 2.6% for personal consumption expenditures by the end of the year. In 2026, they're expecting closer to their target of 2%, which is where they want it to be. They are feeling less optimistic. Now they raised those expectations for inflation to 2.7 to 2.8%. Again, The Fed is just feeling less optimistic about where things are going, partly due to tariffs, partly due to, again, consumer confidence and how much they're spending. A lot of that's weighing into all of this, okay? Now let's talk about the Fed funds rate, right? This is the one that gets the most attention, right? So each one of these dots on here is a Fed member's opinion of where they think the federal funds rate should be. Okay, it is currently in this window right here between 4.5 and 4.25%. That is where we currently are. Each one of these dots is where they think things are going to be in 2025, 2026, 2027, and then longer run. We didn't see drastic changes to this. Okay, we saw gigantic changes to the Fed's expectation for GDP, unemployment, inflation. We did not see significant changes to the Fed expectations for the Fed funds rate. 4 members are currently predicting no rate cuts in 2025. That's ludicrous. That's crazy. That's probably not going to happen. 4 members are expecting 1 rate cut. 9 members are expecting 2 rate cuts. That has been the prevailing opinion. That was the prevailing opinion last time when they met as well. So again, no big changes there. And then 2 members are thinking, hey, we're going to have to get a little bit more aggressive and do 3 cuts. Longer term expectations, we really didn't see much change there. All of this points to, hey, look, the Fed is going to be cutting rates, but they're probably going to cut rates slower than we were all hoping for and slower than they were expecting, 6 months ago when they met. Okay. Interesting stuff. Again, maybe if you're only a money nerd like I am, but I am. Talking about inflation. Inflation actually had a pretty good month. Okay, inflation had a pretty good month. Producer price index, that's wholesale inflation. Inflation as businesses feel it. They saw the headline, so all-in inflation go from 3.7 to 3.2%. That's good. Core rate went from 3.8 to 3.4%. That's wonderful. Producer price index has been known to be somewhat of a leading indicator for consumer level inflation. Doesn't necessarily have to be, but that's how it's viewed. The reasoning there is, hey, great. If businesses are paying less for goods, they could pass that savings along to consumers. They don't have to. They could increase their margins and make more money, but they could. So wholesale inflation, the Rodney Dangerfield of inflation, it doesn't get a lot of respect, no respect at all. Consumer price index also saw an improvement. Headline went from 3% down to 2.8%. We want inflation to go lower. Core went from 3.3 to 3.1%. Now, core consumer price index, which is inflation as us consumers feel it, they want that to get all the way down to 2%. They also want the other measure of consumer inflation, personal consumption expenditures, also to get down to 2%. Now on that front, they saw less improvement. Okay, the headline stayed at 2.5%. Okay, the core rate went from 2.64 to 2.8%. That's bad news. Bad news for inflation is bad news for mortgage rates. Like I said, normally tariffs and inflation would be bad for mortgage rates. However, the volatility in the stock market kind of balanced it out a little bit, and we didn't see, a significant increase in rates. Rates basically ended the month similar to where they ended. I like this comic a lot. How much? Clean up on aisle 4. Everybody's just walking through saying how much. Yeah, I get it. Eggflation, especially, we've all seen it. We've all witnessed it. So good news on inflation for the most part, but not so great news on the stock market. That's basically how the month went. So looking ahead, what are we looking forward to in April? I can't believe it's April already. So market roller coaster is likely going to continue until it gets some clear direction. When are tariffs going to happen? Is this tariff talk and ebbs and flows with regards to what tariffs are going to happen and when? Is that going to continue to be a distraction for the market? Yeah, probably, until they get some very clear direction of what is actually going to happen. There hasn't been a lot of clear direction with regards to tariffs, and they have a huge impact on the economy. There's no way around it. The Fed is also in a really tricky spot. Okay, this is kind of interesting. So the Fed has that dual mandate, right? They want to minimize inflation, maximize employment. Well, what do you do if both pieces of those are not cooperating? Inflation ticked up, as we saw with personal consumption expenditures. Also, it's going to be hard to make meaningful progress on inflation, because when you start to look at the numbers that are going to be replaced in May, the numbers from a year ago were really, really cool numbers. So even if there's a slight uptick in inflation, it's going to be replaced in a cooler number from a year ago, and that's going to make it look like the inflation is actually heating up. Okay, that's bad news for inflation. That's bad news for these metrics. Well, if inflation looks like it's heating up and unemployment is also heating up, what does the Fed do? The Fed could cut rates, but that would cause inflation to tick up, although it would cure the unemployment woes. Conversely, they could hike rates. Hasn't even been discussed. But if they do, that's going to decrease inflation, but it's going to make the jobs market worse. So what do you do when both of your dual mandates are going in opposite directions and they're both not cooperating? There was actually a Fed member that came out just a week or two ago, and they said, What would we do in that situation? Well, which one is behaving worse? Okay, if there's two children and neither one is behaving worse, what do? You're only one person. You can only do one thing. Well, you're going to focus on the child that's behaving worse, right? So that's what they said. They're like, look, we're probably going to focus on what's worse. So does unemployment get worse than compared to inflation getting worse? Very possibly. In which case, the Fed would still be kind of strapped in and have to start cutting rates despite inflation being kind of stagnant and stubborn. Yeah, it's entirely possible that that's happening. Maybe the Fed doesn't want to start cutting rates, but maybe they have to start cutting rates, especially if the unemployment rate starts to increase. Okay. Like I said, starting in May, it's going to be really hard to make progress on inflation. The inflation kind of has to make hay while the sun is shining, because starting in May, oddly enough, the sunniest month we have, yeah, it's going to be very hard to make meaningful progress on inflation. So that is kind of it. I hope you all had a wonderful month. Quarter of the year is already gone. Absolutely shocking. Can't believe it. Hope you all have a wonderful month ahead of you. If you have any questions, please let us know. Your referrals are the lifeblood of our business, so thank you all so much for that. We really, really do appreciate it. We never take it for granted. Myself and Team Staufer, we've been around forever, and we really do appreciate all your support. So thank you all so much. And if you think of anything else, holler at me. Appreciate y'all. Thanks. Bye.